Welcome back. It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back with Ryan Loenza. He's portfolio manager at Turner Investments Raymond James, to talk about something Canadians are always focused on, and that's the value of our dollar. It has slumped this year. It's lost about half a cent or so since the beginning of the year. It's trading now at just above 73 cents US. This is largely a story of US dollar strength. As we'll see in a moment, the greenback has gained against all of the the major international currencies. There's the Canadian dollar. But you think the Canadian dollar is due to rally in a fairly significant way. Go ahead.
Yeah, so here a couple of key points is, let's stand back. The US dollar, which we've got up here, has just been on a tear. It's up against the yen. The yen's down 10%. The British pound. All major global currencies are down. And it's because the Fed is pushing out when they were expected to cut. Right. So the beginning of the year, the Fed was expected to cut 6 times. I said that was just impossible. And now with the inflation remaining hotter, it's pushing that out. So when US interest rates are higher than Japanese interest rates or Canadian rates, investors flood in. So that's why it's been happening. But when you look at our Canadian dollar, it's largely range bound. I put out a blog a couple of years ago saying it was range bound between low 70s and high 70s. And here's where we are, and we're at the low end of that range. So I do think the Bank of Canada is going to cut first. They could start cutting as early as June. And that may cause the Canadian dollar to fall a couple pennies. So as you noted, we're at 73. Maybe it bottoms out at 71, 72. But then I see it recovering later this year and into next year.
On what fundamentals?
Okay, great question. So then you got to look at what are the drivers of the Canadian dollar. Well, number one is commodity prices. You just noted the copper is almost hitting $5. And I have been bullish on commodities. And so there is a strong long-term correlation. Now that correlation, say with oil and Canadian dollars, is kind of fallen off a little bit. It's not as highly correlated as used to be, but I think that correlation will come back. So if I'm bullish on commodities, I'm bullish on copper, I'm bullish on gold, that should help our Canadian dollar. And secondly, the Fed will ultimately start cutting rates again. And that gap, that interest rate differential will start to come back in. So I do think in the very short term, over the next month or two, if the Bank of Canada cuts, you'll probably see a little bit of a dip in the Canadian dollar. We would then use that strength in the US dollar to sell some dollars. So we have, right now, we're very happy with about a 22% US exposure to the US dollar. And what we're contemplating doing is we get a little bit of dip, maybe that Bank of Canada cut, use that to sell some US dollars. So maybe we go sell one of our US investments, we convert that into Canadian dollars at a very high level, and we either use that to buy some Canadian assets, or we buy a hedged ETF. So long story short, the Canadian dollar has been range bound for the last couple of years. I think it will remain range bound. And it's really simple. When the Canadian dollar is low, you sell some US assets. When the Canadian dollar rallies back up to the high 70, you do the opposite.
When and I think if viewers know that ETFs are what you use on behalf of clients. So when you're selling US assets, you're selling US ETFs traded in US and denominated in US dollars, correct?
Exactly right. So you could, for example, the SPY, the Spiders. This is the largest ETF in the world. This is the S&P 500. So you've got that trading on a US exchange in US dollars. So you could sell that investment, convert it at 138, whatever that is, back into Canadian dollars, and now use that to buy whatever. We could buy maybe Canadian bonds, we could buy some Canadian dividend stocks we like, or you could buy a hedged version of the S&P. So but the main trade here, and remember going back to my point earlier about maybe raising cash. So one idea we have is, well, maybe we sell that US ETF, convert at the very high US dollar, put that into the high interest savings, and then wait for the summer pullback. Wouldn't that be a great trade to basically take some money off of the table, convert at a high dollar, and maybe buy lower? That would be great if it all pans out.
How often do you use Canadian dollar hedged ETFs?
We use them all the time in our portfolios. And so there's that kind of, we have a US dollar exposure. It ranges from say 18 to 22, depending on how much US dollar exposure. And so we're always going to have some hedged ETFs. And it really It's how much US dollars that determines that split.
Right, and when you say we have US dollar exposure of X, you're not talking about your US equity exposure. You're talking about your equity exposure in US dollars.
Correct, absolutely right.
You have other US equity exposure hedged to Canadian dollars.
Perfect. So just to flush that out, so roughly 60% in equities. We have roughly 40% in international markets, and half of that 40 is in US dollars. And the reason you want some US dollar exposure is that when things go awry, when you have the big market decline, what happens? People flood into the Yankee dollar. And so that provides a natural hedge to portfolios during tough times. But now, with that Canadian dollar low and that US dollar high, maybe we take a little bit off. And by the way, if I'm right, it gets back to 78, 80 cents. Maybe you add back some US dollars.
Okay, let's get back to one of our top stories this morning. Residents of Fort McMurray are evacuating some neighborhoods today as wildfires blaze on the edge of the city that supports Alberta's massive oil sands projects. For those living in Fort Mac and the country's largest energy companies, there are a lot of questions about whether this is going to ultimately feel like the situation that played out 8 years ago when fires leveled parts of the city and shut down oil production. Andy Willis is a longtime business columnist with the Globe and Mail. He's been tracking this story and joins us with an update on what's been happening in Western Canada. And I guess the obvious question that I raised there, Andy, is the situation similar to 2016? What do we know right now?
At the moment, this is nowhere near as bad as it was 8 years ago, John. So the evacuation orders are in place right now. And again, this is happening in real time, but the evacuation orders just apply to specific neighborhoods in Fort Mac. It's about 4,000 residents out of a total of about 100,000. And actually, the mayor and authorities in Alberta are trying to get an orderly evacuation. They don't want people panicking, clogging the highways. So those specific neighborhoods are being evacuated. I guess the good news is, and this again reflects the history of wildfires in that region, most of the forests, most of the dry grass, it burned off 8 years ago. You haven't got that dense undergrowth this time around. So the fires are less dangerous, they're less severe. It's bad and it could get worse, but at the moment, nobody's predicting a return to the nightmare that was 2016, when, as you just mentioned, large sections of Fort McMurray went up in flames.
Just devastating. Now, we were mentioning in the newscast, just in terms of what we've heard from the companies themselves, that it doesn't appear that we have seen flames approaching any facilities. But what are the oil companies saying, or what have some of them said so far?
Yeah, exactly. To date, the large producers in the oil sands region have not curtailed production. They're going to err on the side of caution. They've got massive camps. If they see any danger to their large number of employees they've got in the region, they will shut production. They'll get the people out quickly. We know that. We've seen that before. So to date, Cenovus, CNQ, which is Canadian Natural Resources, Imperial Oil, it's all business as usual. And in fact, they're doing a lot of good business right now. So to date, the energy situation is stable. But again, this is going to be an ongoing story. If you step back, climate change is very real. And obviously, the relationship between climate change and the oil sands is an interesting one. So this is a continued threat to oil sands production. These wildfires are just a fact of life in northeastern Alberta.
Well, I'm sure it'll prompt yet another conversation on that particular dynamic, but whether it's the energy industry, whether it's the power industry, every time we keep talking about these events that are tied to climate, it undoubtedly opens the door to a question around infrastructure and how prepared our different industries and our grids are.
Well, that's an excellent question. And at the moment, we're still disaster-proofing the grids, and we're still realizing that severe weather events are going to be an enormous problem for a lot of companies in Canada. The knock-on effects are in the insurance industry and in financial services, where banks have loans to all these energy companies. So, yeah, if you're a retail investor, if you're an institution in this country, you are rethinking risks, you are rethinking valuations based on the fact that wildfires, storms, floods, they can take out large portions of an operation. And it's very difficult to plan for, but it is something that you have to incorporate in valuations.
It's all, well, speaking of valuations, we're at a point where, sure, production is something that you would be thinking about as a big energy company if oil prices are higher. But the industry has gone through so much transformation, in part because it's been unloved, that this is really an industry right now that is, in many ways, taking a lot of the capital that they're bringing in, not necessarily expanding operations, but actually expanding what they're giving back to investors.
Yeah, a lot of these companies, and the C&Q is a good example, which is run by Murray Edwards, probably one of the smartest. He's the executive chairman. He's one of the smartest operators in the country. He's created a company that is largely self-financing. Now, they do still borrow. There is still debt. But most of the big oil sands players, in fact, most of the energy patch, with commodity prices at these levels, they've paid down debt. They're increasing their payouts to shareholders, so dividends, share buybacks. At C&Q, 100% of free cash flow, John, by the end of the year is going to be going out to investors. So the energy patch is more resilient now than I think it has been at any point in our careers. The ability to pay dividends is untouched. Now, look, there's a lot of investors who simply won't own oil sands stocks. That's a policy decision that they make. That's fine. But if you are playing this sector, these stocks are now more resilient. They have lower debt levels than at any point in two or three cycles in the 2 or 3 energy cycles. So it is a very different dynamic out there. And as dividend plays, some of these energy companies are incredibly attractive.
One thing that Eric Netto comes on a lot of coverage of the energy sector said to us recently, because as an investor who's spoken to a lot of these companies, he'd like to see some of them establishing base dividends if they haven't. But until the disconnect between what he thinks the companies should be worth and what the stock market is valuing them at today, he is encouraging them to buy back stock. But either way, we're talking about a lot more capital going towards shareholder-friendly moves. Speaking of shareholders, you've been covering M&A for years within the energy sector itself, because we've seen some transformative deals in the U.S. over the last 12 months. What's the buzz right now? Yeah,
that's a really interesting contrast. Some of the big U.S. oil companies have been doing massive acquisitions. They've been expanding in Texas. They've been expanding their the fracking operations in places like Pennsylvania. None of that M&A has played out in Canada yet. I don't understand why. Every banker I talk to is pitching ideas in Calgary. So, Canadian Natural Resources, Cenovus, they have done acquisitions in the past. The expectation is they will take out either natural gas players or other oil sands players. So the targets, John, I would look at Meg Energy. It's relatively small. Husky tried to take them over a few years ago. Then Husky in turn got taken out by Cenovus. So Meg in the oil sands would be the one company that I think would be open to a takeover at some stage. And then in the different plays, in Monterey and some of the other big basins, there's going to be more consolidation. And the companies that will be buying, or Tourmaline and Strathcona, some of the big players, all the junior companies, I'd say, are takeover targets. I think at some point, you and I are going to be talking about oil patch takeovers.
Well, as we watch the broader market story be dictated by talk of inflation and interest rates, there is a side story in the markets: surging meme stocks. Yes, traders piling once again into the likes of GameStop and AMC a day after both soared in a revival of the retail frenzy. This latest rally seems to have been turbocharged by the return to social media of Keith Gill, as we mentioned in our newscast. He was the individual largely seen as driving the meme stock mania of 2021 under the moniker Roaring Kitty. But what's got investors all of a sudden excited just by him coming back to social media? What does it say about the state of the markets right now? Let's get some insight and analysis. Liz Miller is president of Summit Place Financial Advisors. Liz, it's great to have you with us. Most of my conversations with you recently have been about earnings and interest rates and inflation reads. But here we are with this side story of the meme stocks. What's your take on what's going on right now?
I think it's reflective of the strength both in a consumer and a retail investor that isn't really being embraced in the market. There's this weird yin-yang where we were going to talk earnings. It was a really good earnings season, but you feel like investors and consumers don't feel that good about the market or the economy, even though it's pretty good. I think the meme stocks that are coming back is reflective of that return to confidence.
All right, there you go, the meme stock indicator. And I mean, I guess if I had to gauge your level of conviction around confidence out there, whether it's confidence among retail traders or confidence on Main Street, what's your view right now?
I'm pretty confident in both the economy and this market for the rest of 2024, but I do feel like I'm more at the upper end of that when I kind of read what's going on and hear from people. I think there's a lot of caution out there, and I don't think the fundamentals are a lot stronger than that.
So I guess if we're at the upper end of your own expectations. How does that dictate how you're investing at this stage of the game?
Well, we've had this inverted yield curve for more than 18 months. We've had higher rates that have probably peaked. When I look out the next 18 months, 2 years, I think things are going to be getting better. Now, that doesn't mean there won't be a little bit of volatility along the way, particularly with the election year that we're in. But we're investing for the next few years with a bent towards cyclical and for stronger growth.
Okay, is there any example of a stock within, let's say, the cyclical camp that would represent the kind of thinking that's going into your investing strategy right now?
Sure. We've been adding Fortune Brands, FBIN, and this is kind of a mid-tier company a lot of people don't think about. Some of the brands you would recognize, they own Moen, the faucets, they own Master Lock, the keys and such. And they recently bought Yale locks. Look down at the keys you use for your home. A lot of them are Yale. So it's a cyclical company with a very broad product line. It's a branded product line, and they go into all different kinds of construction uses.
Okay, that's FBIN, and we've been talking here in Canada about the possibility for cyclical stocks to outperform. Are you looking at the health of just the U.S. economy? Or are you looking at some of the trends worldwide as well that might feed into some of those businesses that you're investing in?
We certainly keep an eye on the global macro outlook, and what we see right now is that most of the developed world is moving together. As usual, the U.S. is sometimes slightly different pace, but everyone experienced the same up for inflation. Everyone is experiencing the same down. All central banks are talking about whether to lower rates or not. So we're certainly seeing a global move that is coming out of a slowdown and will slowly move to stability and eventual growth.
And I wonder, in an environment like this, how you start thinking about a group like healthcare, because I feel like all the way as the market has moved up, some of our pundits have talked about healthcare as a group that they like, that offers some good value. It ultimately this year has lagged as a group. I know United Health is a name that you're thinking about right now.
Yes, healthcare, it's hard not to like healthcare with the global demographic trends. It's just a given. Now, does that mean it's going to be a leader in the market in terms of investing? I think it's going to be participate, and that's what we're looking for. Domestically, we've had a lot of news lately about difficulties from Medicare reimbursement. That's our retirement plans here of healthcare. And United Healthcare seems to be pretty well positioned to work through those problems and still benefit. So major health insurer in the United States, and pretty good valuation right now. And we think it's in the right place to continue to do well and then do even better going forward.
Liz, anything you'd be avoiding right now?
It's not a market to avoid. I think there's a lot of talk that the market's at a new high, but what we look at internally is we go back to 2022, January, where the market had been at a high, and now we look forward 2 years and over a quarter, and so much of the market is still flat. So we see plenty of opportunity. Of course, there's a couple of high flyers. It's very exciting to think about AI and the companies that are going to participate, and we own some of those, and we're still owning them. But I think there's a lot in this market you can buy for the next 3 years.
And on the short-term high flyers, the meme stocks we talked about, do those catch your attention at all?
That does not fit our portfolio. I kind of put those in the category, if you like gambling, and you want to take a trip to Vegas, buy a meme stock. But I think it's a great way for some young people to learn about investing. I mean, I see a lot of young adults in particular get excited by these and jump in and play the ups and downs. And I think it's a good experience. Some of them are going to do very well. Some of them are going to learn a lot of lessons about market volatility.
Shares in Northland Power up today. The company posted first quarter revenue that topped expectations. The Toronto-based renewable energy provider says strong wind at its offshore facilities contributed to the outperformance. We're joined by Mike Crawley, CEO of Northland Power. Thanks very much for coming on the show, Mike. Can you just remind us, we know that you're masters of wind offshore Europe in the North Sea, but how much of your portfolio altogether is wind power?
We get about half of our cash flow from offshore wind, right? So we've got 3 large assets in the North Sea, which is where you would have seen that huge contribution this quarter. Our onshore wind also performed well in Canada and Spain, but the principal contribution was from those 3 large offshore wind facilities that we have in the North Sea. They both received really strong wind in the first quarter, but our operating teams were able to keep those facilities operating at a really high level of availability, so they were able to capture that wind.
And what other forms of generation are you involved in?
So we cover the renewable spectrum by and large. We have solar generation, onshore wind, offshore wind, but we're also building a battery storage facility right now in Ontario. And if you look at what's going on with the sector, the power sector moving forward, there's going to be a lot of energy needed. So that's kind of solar, wind, offshore wind that has to get built over the next 10, 15 years. But you need to stabilize that. You need to firm it up. And one of the ways that you do that now is with battery storage facilities like the one that we're building near Brantford, Ontario, 250 megawatt facility, which is one of the largest in the world and certainly the largest in Canada.
That's big enough, 1/4 of a gigawatt. I mean, Ontario, this is my touchstone. Ontario has total capacity of about 40 gigawatts. So this is a big operation. You say it's big on a global scale, this battery storage plant?
For sure it is. I mean, battery storage is relatively new, and it's a way of doing what gas peakers used to do and still do in a number of jurisdictions, which is when the wind drops off, the sun goes behind a cloud, you can get energy quickly from a battery storage facility. So it's a really important part of grid planning going forward. And we were able to secure with partners a contract for one of the first in Canada of that scale, and is well on its way to being built. It will come online in the middle of 2025.
And what is it? Is it just a bunch of giant lithium-ion batteries?
For sure, it's exactly what it is. So it's a number of batteries that are built out in sequence. So right now at the site, we've got all of those battery packs have been delivered, all of the foundations poured, and the teams are now just working at connecting them up with a view to bringing that online, like I said, middle of 2025.
Just looking at your stock, it seems to have traded broadly in line with the other clean energy stocks. If we look at a 5-year chart, we can see you peaked out there in early 2021, along with a lot of the other renewable energy stocks. Why has this sector come down so much since then?
Well, a portion of it is interest rate driven, right? So all of the stocks in the sector generally are interest rate sensitive. So both because they require a lot of financing to build out the assets that we operate, to construct them and finance them, but it's also just a function of yield and adjusting the yield from our stock on our dividend to whatever the interest-free rate is for money at any given time. So you've seen historically high interest rates, and you've also seen historically high, of course, inflation, which is not good for the sector. But what's changed going forward, if you look at what's happening now, inflation is coming down significantly over the last 6 months from what had been last year really historic highs, or certainly as high as it's been in 30 or 40 years. Interest rates look like they're going to follow down soon. So all of that bodes well for the sector. So what has remained constant is the government support for the sector. And what has increased dramatically is the demand for power across the board, but principally from data centers and from tech most broadly.
You do have big growth projects in hand in the Baltic. I think it's offshore wind. And you also have in Taiwan a massive installation going in.
That's right. So they're both about 1 gigawatt each.
Wow. And
both projects are now well advanced in construction. So if you look at the components and the major elements of each one of those projects, they're all under construction or fabrication by and large in some form. In Taiwan, the in-water construction has begun. So recently, two big jacket foundations were installed that will support the offshore substation. One of the offshore substations has already been delivered to Taiwan as well. It's a 6-foot tall structure. So as we said on our earnings call this morning, the construction is proceeding according to schedule and according to our original cost assumptions. So we're generally feeling very good about that construction program.
It's kind of interesting. I thought a bunch, well, I'm thinking about North America. I thought a bunch of wind projects had been postponed because of cost overruns. Have you escaped that?
Well, that's right. So if you look at the eastern seaboard or the northeastern seaboard of the U.S., there were a number of projects that were delayed, some that were canceled because of the inflation and the supply chain constraints that the sector saw last year. So what we did in 2023 is we did a few things. Number one, we did exit one project that we managed to sell our interest to our partner and recover all of our costs. But on these two big projects that we're moving forward with, we're able to go back and renegotiate, change the revenue contracts on them, increase the cash flow that we were going to get from those investments to offset some of the capital cost increases. And we were also able to work creatively on the financing to keep the financing costs down so that we could bring those projects into construction through financing and get them to the point where they're at now. And if you fast forward to 26 and 27, when those projects will come online, they're going to deliver to Northland an incremental $600 million in EBITDA and $200 million approximately in free cash flow, along with the battery storage project we talked about earlier. So a substantial amount of free cash flow and EBITDA growth once those projects come online, and they're already well under construction.
And your yield about 5.1%. And as far as I can see, you've been paying a 10-cent regular dividend for quite a while, monthly, and you haven't changed it.
That's right. And so the dividend is certainly very important to a lot of our shareholders. And we've certainly been reaffirming to shareholders that we intend to continue to support that dividend. Obviously, go forward decisions are the purview of the board of directors, but it has been an important element of the total shareholder return from Northland, that you have an element which is a dividend, and then you also hope over time and would look to over time to get some growth in the share price. And when we look at what's happening with the sector right now, we certainly see a lot of interest in terms of investors looking to come back into the sector. And we're making the case about how Northland is differentiated from some of the other peers in the sector, given the amount of growth that we've got locked in and the unique position that we have with the talent pool that's able to develop and construct projects at scale, like the offshore wind projects that you've referred to.
You're watching Trading Day on BNN Bloomberg. I'm Amber Canmore. We're watching shares of Applied Materials. The company posted an outlook that failed to live up to high investor expectations. This is a company that makes equipment for semiconductor companies as well as display screens for everything from phones to computers. Let's bring in Brian Chin, analyst at Stifel, who's got a buy on the stock. Brian, first, before we talk about the quarter, can we explain the run-up in the shares? Because it really did meaningfully outperform the last couple of months.
Yeah, hi, thanks for having us. Really appreciate it, Amber. And so, so Applied Materials, one of the really the largest semiconductor capital equipment company. This sector has been in favor, even though it's kind of interesting. You haven't seen a lot of inklings or inclinations of a broad recovery in the spending from companies like Intel and TSMC that typically catalyze this. But even going back, more than 12 months is when you kind of find the bottom tick on this stock and on this space. And so it's a lot of anticipation of a strengthening cyclical recovery, but really kind of the lead aspect, which I'm sure we'll get into, is AI and kind of how that has had a positive initial impact on growth off the bottom, I would say, for the industry.
Yeah, that was going to be my next question. I assume that a lot of this is an AI factor that isn't necessarily, and you tell me, is it showing up in the business today, or is the hope that it shows up in the business soon?
It's a little of both, if that makes sense. So it absolutely has actually been a catalyst for several companies, including Applied Materials, in terms of stimulating some growth when sort of the market's been devoid of growth, and some of those traditional, big consumers of semiconductors. And so the smartphone market, the PC market, that's been kind of declining and sort of sluggish markets over the past few years. And so it's interesting. There was, overcapacity in this industry last year. And because of that, there wasn't really a lot of new capacity that had to be added in order to maybe service some of this AI demand. But the interesting thing is now that some of that capacity is starting to be fully utilized. And so that's usually the trigger point to indicate that new capacity is probably not too far on the horizon in terms of having to be added into this industry. And that's sort of the thought process on 2025, maybe being that time frame.
We're still talking about a business that, barely grew top line sales and is forecast to only grow by low single digits. So a two-part question, why the buy rating? And second, can AI meaningfully accelerate that top line growth?
Yeah, so this is where maybe I'll do a broader context for Applied Materials specifically. If you look at their revenue last year, it was maybe flat, up 1%, something like that year over year. But if you look at some of the peers in the space, they were down 17, 18%, mid 20% year over year. And so Applied on a relative basis for what was a downturn year in spending, where memory companies like Micron, Samsung, their spending declined in totality maybe 40% year over year. So Applied actually did remarkably well. And so what's interesting is that even this year, which is sort of, we view not really as a full-fledged cyclical expansion year, but really kind of a transition year from last year being a downturn and kind of transitioning into what we think will be a more potent upturn in 25. Applied actually has done quite well. And so, for example, we think the spending for the entire industry for capital equipment for semis, it'll be up based on our estimates about 15% for next year is what we've published on. And so I would imagine that Applied can benefit from that. And then companies can sometimes grow above that depending on their positioning in the space.
The valuation, though, does it leave room for expansion?
Yes, so the valuation is a good question. The cyclicals are certainly, certainly the semiconductor equipment space. We've observed them being very early discounting spaces where usually as things are getting really bad, oftentimes that was anticipated and somewhat reflected and priced in. And so the same thing goes for upcycles. There certainly was an anticipation of the upcycle, which from a broader standpoint has not really kicked in yet. But again, going back to AI, you've actually seen some fundamentals actually improve, but more in isolated places than across the entire business. And so what people are really starting to and us as well, value these companies are based on peak expected earnings potential in the upcycle. And so we view it as a growth cyclical space. We think Applied is a growth cyclical, and we think they're going to demonstrate significantly higher earnings than they did last cycle.